Ladies and gentlemen, welcome back to the Capital Flows podcast. In today's session, we are going to be covering interest rates and macro volatility and getting into understanding a lot of the forces that are moving markets. And this is really on the back of a video that I just did recently that went over how interest rates are fundamentally linked to the rise and fall of nations, to prosperity or depression or whatever the macro regime is. They are inherently linked with interest rates. If you want to have a view on any asset, good or service, all of those are denominated in money. And money is the flip side of interest rates because interest rates are the price of money. So the simple metric, if that sounds complicated, is if you think about money and macro liquidity, that's what interest rates are. Interest rates are not a reflection of macro liquidity, they are macro liquidity. And there are some other metrics that we use depending on where we're at to quantify macro liquidity, but interest rates are one of the largest inputs into macro liquidity and to the price of money, which impacts every good and service. It is the asymmetrical linchpin on which the entire economy and financial system turn. And so wherever you're watching this, you can go below and you can see the video that I linked for the previous video that I did, as well as the connected playbook for it that really navigates how to move through credit cycles to the upside and downside as they directly link with interest rates. And that was what the previous video was about. In this video, also connected to it, is a educational primer and playbook that breaks down how to think about trading interest rates. And all of that is free. It's linked below, so you can go down onto the Substack, download it for free, and go through it. And some of those ideas are what I'm going to be expanding on in this video, but you're going to want to go and check out that connected playbook. It's just a PDF on the Substack, and it'll be there. So on the Substack, you'll find that. What I want to start with is a basic idea of how growth and inflation regimes function. And a lot of people are going to use different metrics for growth and inflation, and they're typically going to skip around whichever ones confirm their view. Fundamentally, everyone in macro is trying to predict and have a view on GDP and also gross domestic income, but we won't talk about that today. Mainly GDP. If you have a good view of GDP, gross domestic income is just the flip side of that. So this is a chart of personal consumption expenditures in the price index. So in white, you have the PCE, core PCE price index, which is just inflation. And then in blue, you have real PCE, real consumption spending, and they're both on a year-over-year basis. Now, I'm using these as a rough metric to look at growth and inflation because they are the largest components of GDP. The reason why we use GDP is because it is the most comprehensive metric that accounts for all economic activity. I've done some great podcasts and videos in the past with Prometheus Research. If you go back and look at those, and then you can also just go to their page. They're on Twitter, they're on Substack and everything like that. Best systematic macro analysis out there. And they cover a lot of the economic data really, really well. And I'd encourage you to go over to them. I'm subscribed to them. I think it's super awesome, everything that they're putting out. And it's a really clear picture of what's taking place. But when we think about growth, growth is primarily quantified with GDP. And GDP is made up of, you have your personal consumption expenditures, which is the largest, which just means people spending money in the economy. And then you have your investment line items, your inventories, your imports, exports, and some government spending and investment as well. The main component, though, is personal consumption expenditures, and the main input into that is services, and that's why everyone's so focused on the labor market, because the labor market and consumption are two sides to the same coin. They're not different, right? People will say the labor market lags or does this or that. I mean, if the labor market lags, then GDP and consumption and retail sales, all that stuff lags as well. It doesn't make any sense. They're both the same thing functionally. They're different data sets quantifying different angles of the same reality, which is either income or consumption. which again are two sides to the same coin because every person's consumption is another person's income. When I go and buy food at the store or buy food at the restaurant, part of that money goes to the actual food and the other part goes to the person's wages, right? And so my spending is how they're making money. And then when they go spend money, that's how someone else makes money, and money flows in the system. It's not held by some bankers somewhere that issue it out or held by corporations. It's just moved around in the accounting mechanism because we can all have the same, if all of us bank at JP Morgan or Wells Fargo or B of A, and we all have a business account or a personal checkings account there, all we're doing is moving money back and forth between the same checkings accounts. And that is the flow of money through the system as we exchange goods and services. So this chart shows the price index for PCE, for personal consumption expenditures, and also the blue shows real consumption expenditures. So why I shared this chart on a longer term basis, you can go into actually the spreadsheet that I have on the Substack, I'll link it below, maps all of this data every single month. And it comes from the personal income and outlays data set that you can go in the Fred database and find. And the spreadsheet on the Substack, it's 100% free. You can go there and map this data against interest rates. It does it all for you. So you literally don't have to do anything. All you have to do is connect it to the Fred API, and it'll auto-populate all the data for you. And if you think that sounds complicated, the entire spreadsheet's already built for you, and it has instructions for every single step of the way. So that even someone like me could do it, because I suck at building spreadsheets. And I have, through my time in the financial industry, I have learned the skill of not basically finding other people to build spreadsheets for me. That is one of my skills in life, because I could not do it myself. I actually just didn't want to learn. But on the side for data, we have different regimes of growth and inflation. And so when you had this period of time in the 1970s where you had interest rates move to highs, there is a critical difference with what we're seeing right now compared to history. And so when people talk about the 1970s as a parallel, you have to recognize the underlying growth and inflation was fundamentally different than what we are seeing right now. You will notice that during the 1960s and 70s, when you had these inflation spikes and you had recessions, notice that you had inflation literally going parabolic and growth, real growth, moving directly down and in contraction below zero. That is very different than what we're seeing today, especially on a year-over-year, month-over-month basis. And so you'll notice that these moves that we are seeing, that is one of the reasons why you had rates blow out to the upside as equities went down, and you had tops in inflation mark the bottom in equities because there was bottoms in growth as well. Mainly what takes place during these periods of time is that inflation in itself can have a contractionary force on liquidity because every single corporation, as well as you and me, when we run our own income statements, we have constraints. So a corporation, they might sell something and they benefit from the inflation, but then they're going to have to catch up with wages, right? And they're going to have to pay people more wages. And so they're a flow function in how they're transmitting inflation through the economy. And a lot of people are going to try to come up with different reasons for, it's monetary this, dollar devaluation that, whatever it might be. The transmission mechanisms of those things are all pretty clear. Those are not really the debating function for things if you just take the economic data and connect it to nominal demand correctly. Because if anyone is, all the sources of money that we have are pretty straightforward overall. The entire question is more about the time horizon and which drivers are going to have an impact. But when you just break down the economic data, it all nets out pretty clearly. So the 1970s was really about that. And then since that time, you had more of a convergence with growth and inflation, which means that especially in the 90s and the 2000s, and then especially the 2010s, what you began to have is a tighter range for growth and inflation, and you had it compress a lot more. There are always periods of time where one is going to go in an opposite direction or something like that, and those are always super important to recognize. But this period of time that we have seen right here, we still had growth and inflation move in lockstep, and now inflation fell during this period of time in 2023. And, excuse me, let me restate that. Growth began to normalize in 2022 as inflation was still elevated. 2023, we began to see the reconvergence where they were both kind of moving in lockstep again. Now, the entire question is, where is growth and inflation going to go? And the next chart that I'm going to share is just of 10-year interest rates in light of this. And the key thing to take away from this chart is that interest rates move based on growth and inflation. And you will notice that inflation, if it's going through the roof and growth is collapsing, like in the 1970s right here, you're going to have interest rates rise. That's what they did in that period of time. You know, bonds, everyone thought before 2022, again, it's just because they weren't studying history, that if equities went down, bonds would have to go up. And there was this entire 60-40 play, and everyone said, hey, as long as you own stocks and bonds, you're going to be fine. Well, when 2022 comes around, everyone realizes they got caught with their pants down, and they began to recognize that the drawdown they had in 2022 was almost as great as the one in COVID or even the GFC, because both elements of their portfolio created a drawdown, and there was no offsetting assets that helped manage that vol and that drawdown. As we move through these periods of time, though, you will notice that you have 10-year interest rates trending down. And part of that is, again, that longer-term compression that we're having with growth and inflation, the convergence of them. And then especially more recently, right now we have real PCE running at 2.1% on a year-over-year basis. That's what we call a normal range. Like, that's what we call normal growth, is around 2% real growth. And then we have inflation around 2.7% for core. We're not back down at 2. We're still a bit elevated. And the fact that we have both growth and inflation at these levels and normalized with interest rates at these levels is an indication of where we're at on a macro basis. Now, how do we begin to connect this to the Fed stance and how we think about interest rates? When you think about interest rates overall, the Fed can hold interest rates above or below CPI. So this green line right here, well, actually, let me go to this white line first. This white line is the real PCE, real personal consumption expenditures. So it was in the last chart that we showed. So this is just real growth, real consumption in the economy with, it's not reflecting inflation. The green line is of Fed funds minus CPI. So we're basically saying, how far is the Fed holding the, rates, short end rates above inflation, above or below inflation? So you'll remember that during 2021 down here, the Fed was suppressing rates below inflation, and now they're doing the opposite. They're holding rates above inflation. When the Fed holds rates below inflation, it fuels growth. And then when the Fed holds rates above inflation, it puts downward pressure on growth. Now, the entire question that the market is trying to provide, everyone already knows that. That's not like monetizable alpha at all. Everyone knows that in the market. What provides a monetizable edge is knowing how restrictive we are and how much risk there is for growth or inflation to change dependent on the Fed stance. That sounds complicated. It's because it can be, because there is monetizable returns around that if you can understand that. And I put both of these data points on this chart because real growth, the higher real growth is, the higher the Fed can hold rates above inflation. Let me say that again. The higher that growth is in the economy, the higher that the Fed can hold rates above inflation. So right now, inflation is, if we're using just PCE, which we're doing here, core CPI. This is just the Fed funds minus core CPI in green. We're about, between the 2.5 and 3% range, right? We're going to have CPI next week, and I'm going to get to that in a little bit. But that reflects how much the Fed is holding rates above inflation. The question is, how should the Fed target that spread? Right now, that spread is 140 basis points, 1.4%. It's holding right here. The question is, should the Fed be holding this at 1.4%, or should it be lower, like 100 basis points or 1%? And the answer to that is the Fed will bring rates closer to inflation or even below inflation if things are blowing up in the economy, if the economy is weakening, if the labor market is weakening. And how do you know that? You just basically look at credit spreads and inflation swaps and things along those lines. So right now we are in a period of time where the Fed is still holding rates above inflation, but growth is still at 2%. So they actually have the ability to hold rates above inflation right now without the economy collapsing. Why? Because underlying growth is resilient. If growth begins to move down and contract more, then the Fed will have more room to bring interest rates closer to inflation without the risk of increasing inflation risk. So this is a shorter term chart of basically the same thing, but I overlaid also 1 year inflation swaps, or 1 year rates minus 1 year inflation swaps. And I'll explain this chart because this is a chart that I look at every single day. Right here is, in green, is the same chart we just saw previously with Fed funds and inflation minus CPI. This chart is the 12-month rate. So we're saying what are nominal rates, not for Fed funds, but 12-month nominal rates minus 1 year inflation swaps. So what is 1 year nominal rates minus 1 year inflation swaps? And that is, in one sense, how we kind of calculate real interest rates. You're basically going to see a similar pattern if you look at 2 year or 10 year real interest rates. And it is how much is the Fed holding rates above this level? And then how is it functioning across multiple durations, right? For the 2 year, the 10 year, the 30 year. And what we are seeing right now is real interest rates fall, or basically the spread between 12-month nominal rates and inflation expectations fall. When this is taking place, when this is falling like this, it is creating a positive liquidity impulse for the economy. So it's basically saying the more loose that the Fed is, and they're allowing the forward curve to be, that is allowing real interest rates to fall, and it is creating a positive liquidity impulse into the economy. One of the main reasons why we've seen an equity rally over the last 3 months, and why I'm long equities right now, as I've laid out in the Substack for paid subscribers, is this positive liquidity impulse, which the Fed is being too accommodative because growth is not collapsing. And I'll zoom in a little bit more so you kind of get an idea of this. But this chart, this bottom panel right here, is the same as this white line. Okay? So what we are seeing here is you have 12-month nominal rates right here in white. And you can see that the Fed has held rates. They had their hiking cycle in 2022, held it constant in 2023, cut in 2024, and then have been held constant since then. When the Fed is pausing like this and not moving rates in a significant direction, as inflation is rising, as inflation expectations are rising, that pushes more money into the economy because more inflation is beginning to get stimulated in the economy because of supply and demand pressures and nominal demand, and the Fed is pausing, right? So more money in the system as the Fed doesn't tighten policy means that you have real interest rates fall, and then you have more capital move out the risk curve to buy risk assets. That's one of the main impulses into the liquidity impulse that we have been seeing, and that has been one of the reasons I have been long equities, and that is also the main reason why we've seen the rally in Bitcoin and things like that. So the question is, how do we pull these factors together to think about what we're going to see as we move into the next inflation print and as we move into the changes in interest rates into the end of the year? Because in my view, you are going to have macro volatility begin to spike up in interest rates again because of the risks that the Fed is actually beginning to implement in a policy error manner, in my view. So last week, we had the PCE print that came out above expectations, and everyone is talking about, well, all the inflation is because of tariffs. Not really the case. We're actually seeing core services accelerate and come in above expectations, which is this chart right here. Just think about it like this. If the only source of inflation was tariffs, where would you see the inflation? It would be only in durable goods, which, here's the durable goods chart. Yeah, it's rising a little bit. It's something we're watching, but we're also seeing core CPI or core PCE services sector still remain at 3.5%, and we're not back down to this 2%, 2.5 median level that we have been at on a historical basis. And everyone will say, well, that's where we're going. Well, we don't know that 100%. Where the market is pricing the risk of a future acceleration of inflation dependent on the Fed stance plus growth. So if growth is accelerating or positive in the economy and the Fed cuts into positive growth, that creates a risk for higher inflation, which is what we have been seeing. So we've had inflation swaps right here in orange accelerate pricing this inflation risk, and now what are we seeing? We saw the PCE print come out last week above expectations. We're moving into the CPI print next week, and what are we expecting? Consensus is already forming around a 3% core CPI rate. Again, core, right? Where the prior print was 2.9%. And so that is going to begin to frame a lot of the discussion forward. Everyone's kind of retrospectively focused on the NFP print, which, I laid out for paid subscribers on the Substack. And if you go into the Substack article that's linked to this video, I lay out the ZT short and ZN short that I laid out the view on August 3rd. So we kind of coming into this week and basically saying, look, this NFP print, single print, we actually came out positive. So we added jobs to the labor market, and you had positioning blow out on that was just unrealistic in my view. And now what are we seeing? As we're moving into CPI and the market is readjusting its expectation and re-anchoring to a higher nominal GDP environment as opposed to a recessionary environment, that is going to push ZT and ZN down and rates higher, in my view. We're already seeing that begin, but again, that view could shift or I could be wrong on that view, which is why understanding the framework and the different probabilities is so key, right? Because I tell, if you're new, I tell people all the time, I tell subscribers all the time, right? Like, I can totally be wrong in how exactly the outcomes for these things take place, which is why you always want to understand the macro framework, the drivers, and the scenario analysis for it so that you can know exactly when you're wrong and just change. So here is expectations for the CPI print. On the right here is ES and then also ZN. So ES here, you have the historical performance of ES over an hour period post the CPI print. And all this is showing is, on the last CPI print, what happened to the S&P 500. We had it rally on the last two prints, and then in May 13th, we had it move down, and then on April 10th, had a little bit of rally, move down. The range for inflation right now is not super wide for ES compared to, bonds. I mean, for both of them, it's been compressing for a while, which is why that could be setting the stage for more macro expansion and volatility. And then here is the range for ZN. Again, nothing too crazy, but still, significant. And so going to be watching that as well. What would be the major takeaway for this period of time that we're in? And here is what I would say. Long end yields blowing out is a higher probability than a recession right now. Does that mean it's going to happen? Not 100%. We don't know. It's in the future. We're ascribing probabilities to the future because we never know what's going to happen exactly. New information could come to light tomorrow or over the next 2 months that begins to shift the entire kind of stance, and that's why we need to change and adapt. But my view right now is that based on the underlying data, the fact that the Fed has been accommodative and they're going back and forth between 25 and 50 bips this year for cuts, and then we just tried to price 75 bips almost in the Z5 SOFR contract for cuts this year. The fact that we have that stance, the Fed is choosing between how dovish they're going to be as inflation expectations are above 3% in one-year inflation swaps, as credit spreads are at lows, as equities are still at highs, and we're seeing positive growth signs in the system. All of those factors and the collocation of them, in my view, is creating a higher probability of long end rates, here's 30-year rates, moving above 5% and moving to new highs, as opposed to moving to 4% betting on a recession. So that is a key point because at best, I think rates are neutral. Until we begin to shift in the Fed stance and the Fed tries to take a little bit more of a, strong stance in markets, or we get some of this inflation risk out of the market, one of those two needs to take place in my view before we can begin to have a durable move down in yields. In the interim, people are continuing to focus on all of this noise from the media about, Trump or the Fed chair or whatever that might be, and the Fed governors. Like I've said in the last video and in a lot of threads and reports and things like that, it doesn't matter if Jerome Powell or Donald Trump is the Fed chair and they cut rates to zero. If they cut rates to zero, the long end will price what the Fed is making a mistake in. So if the Fed cuts rates to zero next year, then you're going to have long end rates blow through the roof and price the inflation risk. If, and again, yield curve control is not on the table, but I'm just using this example as a kind of point of illustration for the mechanics. If the Fed and the Treasury decide to do yield curve control or something like that, that would simply cause the dollar to sell off and it would be reflected in the currency, right? Risk is always expressed in nominal and real terms, always, no matter where you are. You can always try to move that risk around, but fundamentally it's always going to be priced somewhere. And that, especially in the US with an open capital account and everything like that, it's going to be priced in either long end yields or the currency. Because yield curve control is not on the table right now, my view is that we are likely to move higher in long end yields into the end of the year. And I've been laying out the incremental progress of that on the Substack because we've clearly had a lot of choppiness in the range here. And, we moved down, and then we've moved back up and things like that. And so the execution of it through these different prints and these different changes is critical because, you can have the view that long end yields are going to move up. And sure, you can put on a bond short with a really wide stop. But the entire goal is if we can manage some of the interim risks, then that can be really helpful, which is why this U.S. interest rates trading tactical playbook is laid out on the Substack, and it breaks down a lot of those factors. It lays out a historical overview of the macro regime, the catalysts that you want to be thinking about and watching, and then it also lays out the different contracts and how to structure trades and things like that. All of that is laid out in the interest rate trading tactical playbook, and that is 100% free. It's laid out on the Substack. It's linked there. You can download it. And then also the entire interest rate primer with every single educational resource you would want on interest rates is laid out there on the Substack as well. And it is linked below. And in the linked article below, you can see a full breakdown of the previous video that I mentioned, some of the charts from this presentation today, this trading playbook, and the interest rate primer with all the book recommendations for interest rates. And then also I linked there the video that I published last night, which breaks down how I'm thinking about my view in equities and the levels in equities and bonds and Bitcoin and things like that. So everything is laid out on the Substack at capitalflowsresearch.com and also on the YouTube channel. If you're a subscriber to the Substack, just a free subscriber, that's where everything is, right? I know people are following me on Twitter and YouTube and everything like that. I am aggregating everything on the Substack for the specific reason that it is in one place, and you can always go to the Substack to find everything. And again, I tell this to everyone who is, newer to the Substack or trying to figure everything out. You don't need to become a paid subscriber right away. Just go spend some time in all the educational material and build a really good foundation for how to think about macro, how to think about interest rates, and how to think about this period of time that we're in, so that you can have a clear view of markets. And then you can go to all the real-time analysis in the paid section. But I really encourage people to go through the educational primers first, which is here on the Substack on the main page. And just go through all of those. Like, all of those are free, right? And tons of book recommendations, tons of papers, models, and everything else. And then in this top left section is the macro regime tracker. That is a full breakdown of all of these systematic models that are sent out every single day. If you go to the most recent one of those, that is where the spreadsheet is that has all of the data that I talked about today. There's a full spreadsheet on that. There's also a spreadsheet for every single major real estate sector, real estate data point that breaks down how mortgage rates are impacting real estate and sales and home prices and things like that. All that's there. All that's free. You can find all of it there. And I will be laying out more research on the Substack for interest rates and equities as we move into the weekend. And with that, I will see you guys soon.